Hello traders, welcome back to Nova channel, and let's continue the next part of the lesson, fair value gaps. And now I will show you what is the bearish fair value gaps. Bearish fair value gaps are formed when the price moves lower impulsively, creating the pattern in the process. This zone is one established at the secret resistance zone, where the price may revisit and potentially reject. Just like bullish fair value gap, bearish fair value gaps can come in four forms. And the first one I will show you in today's lesson is perfect fair value gap. A bearish perfect fair value gap is formed when the third candle is a small, consolidating candle. The candle does not close above the previous candle's closing price. This implies a high chance for the fair value gap to be revisited in the short term. And the next pattern is about the breakaway fair value gap. A breakaway fair value gap is formed when the third candle is a large, expansive candle. This implies strong bearish momentum and a low chance for a fair value gap to be revisited in the short term. Aggressive traders may consider going short at this pattern close, as the price experiencing a strong bearish momentum and unlikely to retrace immediately. And the next pattern of fair value gap is the rejection. A bearish rejection fair value gap is formed when the third candle closes into the second candle. This implies weakening momentum and a higher chance for a fair value gap to fall if revisited. It does not invalidate fair value gap, but it does call a need for a caution for traders looking to go short. And the next one is inverse fair value gap. A bearish inverse fair value gap is formed when a previous bullish fair value gap is broken to downside. This implies that an imbalance, where sellers previously had little opportunities to participate, has now been reclaimed by smart money. As the result, this reclaimed zone is likely to become a level where smart money may step in to defend. Additionally, a bearish inverse fair value gap often forms alongside another fair value gap, creating an overlapping zone. This overlap acts as a key area of interest, offering traders a powerful zone to watch for potential rejection. And now let me show you how to identify the fair value gap. A fair value gap is the best identified at a significant support or resistance level, where they are most likely to occur. Understanding this will help you simplify the process of looking for FVGs. Additionally, when identifying a fair value gap, the wicks are more important than the closing prices. This is because closing price alone do not fully communicate when the price action has taken place. And remember, we're solely interested in the areas where the price has passed through but not revisited, making it a valid fair value gap. And now let's move to the next part, the structure of fair value gap on a chart. FVGs tend to occur at key prices which have increased buying or selling interest. This translates to support or resistance zones, or at even other fair value gaps. At these levels, smart money may step in, while institution order may create related large candles, leading to the creations of FVGs. At the next part, I will show you how to identify supply and demand zones for fair value gaps. A fair value gap acts as a support or resistance, depending on its position related to price and whether it has been mitigated. Once an FVG has been reached, with meaning order within it have been taken, it loses its validity as support or resistance. However, sometimes a FVG can appear to be very large, making it difficult for traders to pinpoint where exactly to enter trade. This is where using the consequence in Rogers or CE 50% mark of the FVG as the point interest can help standardize the process. The price should not be closed below the CE in order for a successful bounce or rejections to be considered. Additionally, using a lower time frame to find a smaller FVG within a larger one can help provide refined entries. That is the lesson today. Thank you for your watching. Happy trading and see you in the next video.